Okay, so now in Chapter 11, we're going to talk about bonds issued at a discount and how we record those. Bonds issued at a discount. So realize that when we issue a bond at a discount, that means I'm not going to receive the full amount of the face value. So I'm not going to receive a full cash for that. I'm going to receive less than that. And then we're going to have a discount that we have to record specifically. So the example again that the book gives is another $100,000 bond. The market rate of interest is 13%, oops, 13%, and the coupon rate of interest is 12%. The term in years again is 5, and the payments per year again it is semi-annual, so 2 payments per year. And I just realized when I copied that over, I didn't copy these over. Sorry. And easier fix to do this. Yeah, maybe not. Sorry about that. Just one. Why was it wrong? Number. Okay, so $100,000 bond, market rate of interest is 13, the coupon rate of interest is 12. As we learned from the very first video, if my market rate is higher than my contract rate, then it is sold at a discount, which means less than face value. In this case, after my present value calculation, I see that's 96,405. They rounded in the book to 96,406, which is fine too. But this would be a more exact number. So how I record a bond issued at a discount in the first place is I'm not going to receive cash of all 100,000. Instead, I'm going to receive cash of this amount here, the 96,405.58. So that's going to be my cash amount, because that is really truthfully all the cash I'm actually going to receive. My bond payable at the end of this bond, I still am going to have to pay the $100,000. So that can't change either. I do owe $100,000 in face amount at the end of this bond to the owners of those bonds. So what the other account that I'm going to use here, which is a contra liability account, is a discount on bonds payable, which is the difference between the two. So 35, 94, 42, or like I said, they rounded it in the book, but 35, 94, 42 would be my discount amount. Now, the problem is that this discount really should be spread out over all the payments. So every single time I make a payment, I should use up a little bit of this discount. And I will. And there's two methods to do that. There's the straight line method and the effective interest method. The effective interest method is the more difficult one. It is technically the one required by GAAP. The vast majority, at least when I was in practice, used the straight line method, and then we would run the amortization through the effective interest method. And if the difference was not what we call not material, we usually leave it as it is. So for this class, purposes of this class, we're just going to show the straight line method. So we'll move on from there. The straight line method really similar to how our straight line method of depreciation works, means I'm going to use the same amount every single time. So I'm going to make sure that every payment, every interest payment, I'm going to use up an equal amount of that discount on bonds payable. So I'm going to figure out the total interest payments first. And total interest payments in this case is just going to be the term in years times the number of payments per year. So there's a total of 10 payments. And then now I can find the discount per period, or the discount per, let's say discount per interest payment. How much of that am I going to use up, or how much of that am I going to amortize, is the term we use, for every single payment? And the answer to that is my total discount divided by the number of payments, so it's equal. So 359.44 is how much that's going to be. So when I make my first, this is my January 1st entry, when I make my first interest payment on June 30th, It doesn't change, just because I sold this for a discount does not change the fact that I am going to use cash and I'm going to pay the full $6,000. Okay, I'm going to pay $6,000 no matter what. That's my stated rate. That's the agreement. That's what the contract says. That's what I'm actually going to pay. But the difference is that I need to amortize some of this discount on bonds. So what I mean is I need to use some of that up. It's got a debit balance right now, and I want at the end, when I get done with this, this should be zero. So I want to use 1/10 of this up, and we figured that out already. That's $359.44. So I'm going to credit discount on bonds payable for $359.44. Is going to be means I could receive all of the bond or all of the face amount in the first place. My interest expense really is more than just 6,000. It's 6,000 plus the 359 because I didn't end up receiving that for $3,500. So what that effectively is interest, but I'm spreading the interest out equally amongst each payment. So the good news is with the straight line method, if you use the straight line method like this, it's pretty straightforward. This would be my June 30th entry. And because it's a straight line, this would also be my December 31st entry. So it would be the same every single year. So I'd have 10 entries like this effectively. Now, what does this do to my discount on bonds? So let's make a T account, discount on bonds. I'm going to do my debit side and my credit side. This isn't a journal entry. This is a T account. So this is a balance just on one single account. So you got to think of it that way. So balance just one single account. So what I do to it in the first place, I debited it for $35.94.42. And with these two entries, I have credited it for $359.44 and $359.44. And what's going to end up happening is, I'll move this down a little bit. I don't know if I have 10 spaces or not, but let's see, 1, 2, let's see how many I got here. 9, I need one more. Okay, so I'm going to do this 10 times. So what the ending balance is going to be, and there is going to be a little bit of a rounding problem here, but what the ending balance is going to be, if I add all this up, that's 359 for 40. So there's a 2-cent difference, and that's just a rounding problem. But effectively, I've made this zero. So every time I'm going to adjust this, and by the end of the term, it's going to be zero, so I will have no more discount. So at the end of this, the discount will all be gone. So when I actually pay the bond back in the end, it's going to be the exact same, assuming I go for the entire time frame. It's going to be the exact same thing as when I paid back a bond that didn't have a premium or discount, because there's going to be no discount left. So my paying back of the bond in the end, so December 31st of year 5, is going to be a debit to bonds payable for 100,000 and a credit to cash for 100,000. And that will effectively, since I've chipped away at this discount every time I had an entry, after this transaction, assuming I have the other 8 entries for this, all these would be back to zero. The bonds payable will be back to zero, the discount will be back to zero, and it would all be gone. So that's what amortizing a bond discount looks like with using the straight line method. It's a simpler and more straightforward method, even though technically it does not gap. So the next video, we're going to look at doing the same thing with a bond premium. And if you think about what's going to happen with a bond premium, it's just going to be pretty much the opposite of this, because a bond premium means I got more than 100,000. So I'm going to do the same thing, same amortization. It's just going to be the reverse, but we'll look at that in the next video.